Can you affect central bank policy given rates near the zero bound?
I think it gets hard. Look at the ECB. You know, Mario Draghi had massive success from the moment he took over and cut rates, reversing the Trichet hikes. When he came in with whatever it takes in 2012, it was a great success. Then the mix, the cocktail of quantitative easing and negative rates through 2014 and 2015 was hugely successful. Now you know he's throwing, I don't know, he's throwing corks instead of bullets at the problem. The ECB is just about completely out of ammunition, and you can see it crying out for fiscal policy to take over. That is a future that could come to the Fed as well.
Kit, the reaction that we saw in terms of the market starting to price 41 basis points of cuts in July, then walking it back, just to me highlights how whatever the Fed says, the market's then going to ask for more. The dollar also weakened. Is the dollar going to continue weakening if we do see the Fed in some way give in to these bond markets?
Against something, yes. I mean, the problem for the dollar is, I mean, in part, it's what do you mean when you say the dollar in that sense? Because it means different things to different people these days. And what are you going to buy? You know, are you going to buy the euro because that's the obvious opposite to the dollar? Well, you know, it's got lower rates and a central bank trying to see what it can do. Are you going to buy the Chinese yuan? You know, 5 minutes ago we were worried that the Chinese authorities were going to let that weaken through 7 yuan to the dollar. So, you know, it's not easy. I mean, you know, the default is if you can avoid a recession, if the Fed can avoid a recession, emerging markets are cheap. And if the Fed can't, that's illusory. And that's where it all comes down to that first question of Tom's. Can the Fed get ahead of this? Or is the economic cycle, aging as it is, just coming to an end, whatever, because the earnings cycle's turned lower? I'm a bit in the second camp, but maybe not yet, but we're going that way.
Yeah, and it's interesting that you point out the dollar against what, because emerging market FX a little bit stronger in aggregate today, whereas we're seeing weakness in G10. So if you take the view that you've just said of being in the latter camp, how would you be trading the rates market at the moment?
But buying dips. I mean, I think, you know, yields are going down, rates are coming down. It's incredibly unusual, and I mentioned 1995, because even in 1995, you still only needed to sell to your notes after the second rate cut, you know, or just before the second rate cut. It's just kind of, you know, people have faded the rate cycle ever since I started work. And it's never worked on the way down. You keep on buying until the last cut, and then you go the other way. If you know, is what history would say you should do. So I'm terribly, terribly wary of doing that.